Alright, let's move to Chapter 8's problems and see if, after the explanation, if it helps any trying to solve these things. So looking at the actual problems themselves, let's look at question 1. What's the definition of functional currency? It's the currency in which the entity primarily generates and expends cash. That's answer C. If you didn't know what it was, just think of the word functional. Functional. Where does it primarily generate and expend money? Number 2. In comparing these two methods, which of the following is true? So if you go to the chart, I think what will happen is that you'll see that the only one of these that is true is that C, the reported balance of sales, is normally the same under both methods, the average method being what's being used under both temporal and current, or translation and remeasurement, depending on what language you want to call them. So that takes care of number 2. Number 3, which of the following is true for the translation process? Translation process, remember, is the current method. That's what it's the alter ego name for it, is current. So let's see, we got there. If you look at that, I'm not sure that I understand the problem, but I know that A is not true because the current method doesn't affect the consolidated net income, so I'm able to eliminate A. B, I can eliminate because the equipment under the current method is at the current rate, so that's out. D, translation adjustment is created by the change in the relative value of subsidiaries' monetary assets and monetary liabilities caused by exchange rate fluctuations. Well, monetary, we didn't discuss this in class, and I didn't do it in the video, but I might as well do it now because it is part of the lexicon of language you should know. What they mean by monetary assets and monetary liabilities is the concept of cash and payables, things that are denominated, I'm not talking about the currency, but denominated in terms of you have to pay in whatever the exchange rate is when the time comes. That's a monetary asset. If it's things that fluctuate in value, not due to valuation issues with the asset itself, but they fluctuate in terms of they are what they are, but they will fluctuate on the foreign currency. In other words, cash is cash, but it could change in terms of what the exchange rate does. So if you think about it, if you've got monetary assets, that's cash and marketable securities, and you got monetary liabilities, let's say accounts payable, if the dollar goes up in value, it strengthens, well, it affects both halves of that the same way, so the net effect is zero. If the dollar goes down in value, it affects the cash in a translation or an exchange into foreign currency in an opposite direction, how it affects the accounts payable, so it offsets each other. So you would never have, and when you're doing both at the current exchange method, at the current rate, the current spot rate, which is what the current method does, you'd never have a fluctuation of rate fluctuations or translation adjustment due to monetary assets. So that means that C is the answer, even though I don't necessarily understand the language of C. C becomes the answer by default. But I think what it is it says it's a relative value difference in the subsidiary's net assets caused by exchange rate fluctuations, and for the what it's worth department, that is the correct answer. Let me go to number 4. Number 4, hopefully, gets easier to do. So let's see what we got. Here we got a subsidiary of Biner Corporation. They have one asset, it's inventory, and they're working in functional currency of the peso. Since the functional currency is the peso, that tells you that this is a self-serving subsidiary, because if the functional currency is the foreign currency, then or the local currencies, as the case may be, that means we're using the current rate method. That's the translation method. That's just the rule of thumb. And so in that case, when the dollar weakens because the peso got stronger between the date that the inventory was acquired versus the date we're doing the consolidated statements, notice 1 peso bought 16 cents, but now it buys 19 cents, so the dollar weakened, peso got stronger. So which is true? Well, A is not true because we're not dealing with remeasurement, we're dealing with translations. So A and D can be eliminated. Again, remeasurement refers to the temporal method. We're not using the temporal method here, so those are eliminated automatically. It leaves only B and C. And in this case, since the peso strengthened, it means we do have a positive adjustment, and that's what B is the right answer. It's not a C answer because the peso got stronger, so there's a translation gain here. Okay, so 4 is B. Moving right along. I'm having so much fun. You should be too. All right, so let's see what happens. Hopefully these things stay easy. Number 5, at what rate should the following balance sheet accounts and foreign statements be translated? Why did number 5 get put on? Oh, because it's an ABCD question. So we can do this. This is definitely CPA material, all these questions. At what rate should the following balance sheet accounts and foreign statements be translated rather than remeasured? So again, the word translated means we're in the current method. Go to the chart, take a look at that, sort of get an idea of how that chart works. Keep it in front of you. I'm going to allow it as part of your sheets for the exam, so just keep it in front of you. And here you go. So just if you take a look at the translation method, which one of these matches what the translation method does? Well, equipment's current and accumulate depreciation's current, and there you go. That's A. A is the answer. We're done. I don't have to go any further. Problems 6 and 7. And if you look at the other B, C, D, you'll see that they're not true. Problems 6 and 7 are based on this balance sheet, and in this case, we are dealing with the following. These have been stated at U.S. dollars. Okay, fine. That's current rates, historical rates. Is giving us both. Let's see what 6 wants to know. The subsidiary's functional currency is a foreign currency. That means the translation or the current method. And if that's the case, what total should Rose's balance sheet include for the preceding items? Okay, so now we really do have to go to the chart and start figuring out what happens. And in that chart, if I'm not mistaken, and maybe I have to do some math here myself, so the accounts receivable get included at the current rate. Well, everything should get included at current rates. So the answer should be 430,000, just as it is there, and that is indeed the answer. So answer A for 6 is the easy way of doing it. Then we go to number 7, and of course this is going to say now the functional currency is the U.S. dollar, which means we're in the temporal method or the remeasurement process. What should the balance sheet be? So just looking at the chart, we know that we take the accounts receivable. Let's see, we take the accounts receivable at current. We certainly take the goodwill at historical, I believe. I'm going to wind up being wrong on this. The prepaid insurance, I think we take it at historical cost. So that gives us 220, 300, 350. And what would I take the accounts receivable at? I don't have the chart in front of me, which is why I'm sort of struggling with this. I would take the accounts receivable to be at the long-term value. Where am I? I got the wrong number in my calculation here, I think. Hold on a second. Okay, so I've looked at this problem a couple of times, and I'm not sure the textbook has even the right answer, because the chart tells me that the accounts receivable should be at, oh, no wonder, I was looking at the wrong sides. Okie dokie, let me go back to that. I was looking at the wrong chart. How did I do that? Okay, so the rates for the receivables are at the current amount, that's 300,000. The rates for the prepaid insurance and the goodwill are at the historical amounts, and that is 140. So 300 plus 140 is 440. That's answer C. I finally got it. I was just looking at the wrong side of the chart here. Okay, so again, how do you do it? You're looking at the temporal method. The receivables are at the current rates, 200 and 100. That's 300. The prepaid insurance and the goodwill are at the historical rates, 55 and 85. That's 140. Answer 440. We're done with number 7. And what I think we'll do is we'll hold here a minute, because we're going to move on to number 14, 16, and 17 in the next phase.